Hey guys, it's Bronson. So cash flow or appreciation, which one is more important, right? People go back and forth saying, well, should I really be focused on having cash flow in my deals that I do, or should I just look at total appreciation over that period of time? And I think it's a really great question to ask. I've spoken individually in the last several years with over 1,200 investors one-on-one, and this is a question that comes up, right? Which really is more important? Is it important to have high cash flow, or is it important to have long-term appreciation? So we're going to jump into it. We're going to get into a great quote here at the end. I think you're really going to like this one. Okay, so just a quick disclaimer, I am not your financial advisor. This is not financial advice. This is just my opinions and education, so do your own research and your own work before making any financial decision. So cash flow and appreciation. If you look at what cash flow really looks like, if you want to retire, you live off of your cash flow, it sounds amazing, right? So people are really drawn to cash flow for that reason, right? If the cash is coming in, if it covers my expenses, I'm happy, right? So that's something a lot of people are interested in, and I am interested in as well. The other side of that is really appreciation, growing long-term wealth, right? It doesn't matter when it comes in. If I get a big lump sum at the end, that's okay. A lot of deals are structured this way, and it's just something that, deals really have a mix sometimes of both, or they're one or the other. So maybe, in that situation, if somebody doesn't care about when they get paid, just that the wealth is there, then that might be a good way to go. So a couple examples of this. If you're looking at a cash flow deal, we do deals in the ATM space. We partner with the 5th largest operator of ATMs in the country. And we have a deal that we put out periodically where it's very, very high cash flow. It's starts paying out quickly, and within a couple of years, a little over a couple of years, you have about half of your investment back, so you can reinvest. So it's very high cash flow, which is great, and people love it because cash comes back so soon. So when you look at an investment and an investment comes back, soon, it can be reinvested in other stuff. It can cover living expenses. It's almost like an annuity, right? Which is really a positive thing. Another side of that is what happens if you have a very high appreciation deal, a deal that's going to appreciate very steadily over time, or maybe it's a big lump sum at the end. People will like that often. An example of this might be a house that doesn't necessarily cash flow. Like I live in Los Angeles. Now I just did a video on this recently about why I choose to rent instead of own, so you can tell kind of where I stand, that I'm less on appreciation and more on cash flow. But if somebody buys a particular piece of property believing that it will appreciate, and a lot of people have done very, very well in their houses through this. It's not realized yet, but they've still seen a huge paper gain, or if they sold it, they've actually had a realized gain in that particular property. So like here, maybe you wouldn't cash flow by owning a house. It might be a break even if you're lucky, but you hope that it will appreciate over time. So that's maybe an example. There's other things that are more speculative, and we'll get into that here in a second. But basically, there's kind of a couple ways to look at it. Well, I would say there's also a third option. And again, whenever you look at different investing options, it's not either black or white. It's not either, it's all cash flow or it's all appreciation. There are some deals, like I mentioned, these two, that are primarily cash flow or appreciation. But there's also an example of having both. And it's like having your cake and being able to eat it too, right? You want to be able to have some of both, or maybe you like cake and you like ice cream. My daughter's 9, and it's like, okay, well, you can have one dessert tonight. Do you want cake or ice cream? And she'll be like, both. I want both. So if you want your cake and your ice cream, one way to do it is to find a deal that has a mix of both. We do apartment investing. That's our bread and butter. Been doing it for years. And really, one thing I love about apartment investing is that it has a mix of cash flow and appreciation. And it also has an inflation hedge built in. So as rents go up, generally, so does the value of the property, which puts in also rents rise over time. So very common for us, what we'll see and this is just general for the value add apartment deals, which means we come in and we renovate, we cause appreciation, both forced appreciation, which we know if we do renovations on a particular property in each unit, maybe $10,000 per unit, we'll see a rent increase of $200 a month. That will increase the value of the property, which will also increase the rents. An example of this, a recent property we had, the average rents were less than $900 a month. We were expecting to spend $10,000 per unit and see about $200 to $300 a month in rent increases. Well, we're seeing around $420 a month in rent increases. Wow, it's amazing, right? So cash flow has grown, which commercial property like this, the overall value or the appreciation of the property is based on the cash flow or on how much income is coming in. So they're actually kind of directly related in different ways. So anyway, that's kind of one way it works. 7 to 10% cash on cash is a common way to look at it, where you're getting that cash flow per year, typically paid out quarterly, typically takes around 6 to 12 months or longer or less for the cash flow to start. And then you have the appreciation component, right? So you have you're hoping the deal will double in value. The overall investor equity will double over 5-6 years. It's not an uncommon way to look at it. And then with an inflation hedge built in, that rents generally rise with inflation. It's usually a little lagging, but over time, we generally see a pretty strong correlation between those two. So when you look at that, that's something that's really important to look at. So you got cash flow and appreciation. Now, when you look also, the question really comes is which of these is better, right? Which one really is better, cash flow or appreciation? And I would say, again, it depends on your situation. So if you want more cash flow, then you have to look at it. If you want to cover your living expenses, I was able to retire really off of my passive income. And so, if that's something that's important to you, that you want to cover your expenses, then look at deals that are really high in cash flow, because, the idea is to cover those expenses and then you become really financially free. So that's something that you can look at. Cash flow consideration is also with inflation. Does the investment itself hedge against inflation so that your cash flow will rise over time? That's a really important question to ask. Or is it more of a fixed annuity type of thing, which if you're getting an annuity at 4 or 5% and inflation is 7, 8, 9, 10, 20%, you're actually losing money in real terms. So that's something to really consider. And then also when you look at appreciation, now this is something for me, I don't want to say appreciation is completely bad. My friend George Gammon, he says that in general of his portfolio, he puts about 10% of his investable wealth into speculative stuff. Now for me, this is a little challenging because I like to know that I'm not going to lose money. Like Warren Buffett, one of his quotes is rule number 1 is don't lose money. And rule number 2 is don't forget about rule number 1. So, I just don't want to lose any money in whatever I do. But, if you put money into things that basically have higher upsides, such as maybe crypto, maybe gold mining stocks could be another one. There could be venture capital or startups or things like this. So there are the things that are out there that have a much higher upside that you maybe even have a chance of loss, but there's also a chance they could go up by 2, 5, 10 or more times. So anyway, just something to really consider when you look at it. There's kind of a mix of both of those, but it really is important to make your own decision on that. So I want to share this quote for you from Robert Kiyosaki. Again, kind of the cash flow guy. Back on the shelf behind me here, I have his cash flow 101 game, but he has this quote. He says, "I'm a cash flow guy. If it doesn't cash flow, I'm out." So he shows just for him, cash flow is that important, that to be able to be having regular income coming in, whether it's quarterly or monthly on a property, is just incredibly powerful. So something to really think about. I want you to check out this video if you're interested in learning more about apartment investing, what we do. So check out this video up here. It's a great video that just talks about some of the basics of how you actually get started if it seems totally foreign, and learning more some of the basics about multifamily apartment investing on a passive level. So you can check that out. And then also, I want to hear from you. Like, what do you think? I mean, is it more important for you in this stage of life? Is cash flow or appreciation more important? So stick that in the comments. Thanks for taking the time to educate yourself. Look forward to seeing you on the next video.